What kind of analysis do you guys do on TFSAs when you are working with clients? And are there any optimizations or mistakes that people sometimes do that you are particularly on the lookout for?
I mean, I'd say one thing that we see, carrying along this thread, you do see some people that have, a really big exposure to a particular stock or sector in their TFSA that's big relative to their portfolio, where it's like taking
Mhm.
on too much risk. But sometimes I see people that have, they're sitting on cash in their TFSA, and meanwhile, they've got, debts that they're carrying at a higher interest rate. And if somebody has a, secured line of credit, for example, at prime plus one, these days they're paying 8.2% interest. And if you've got
Mhm.
an account that's earning 1% in your TFSA, if you're earning 1%, but you're paying 8.2 on the other side, you're falling behind. So sometimes it's even stuff like that, should somebody be using their TFSA to pay down debt, or if they're high income earner and they've got RSP room, there may be an advantage to tapping your TFSA, taking a TFSA withdrawal, contributing to your RSP. So it tends to be more like
Mm,
strategy, overall financial planning strategy, as opposed to the wrong stock to hold in that TFSA. But do that.
Those are great points. Those are great
gotcha.
points.
Like if someone is, let's say, teetering on a tax bracket where they're just about, like maybe they just exceeded, so they just got bumped up to the next higher one and they don't have enough to max out both RSP and TFSA. So in that situation, is that an example where you would say, hey, maybe instead of pumping money into maxing out your TFSA first, maybe you should put money towards your RSP first, because that could actually get you to the lower bracket. Is that a
Mhm.
scenario where that would make sense from the example you were saying, Jason?
Yeah, for sure. For sure. If somebody's got a high tax bracket, particularly if they're in a high tax bracket, maybe on a one-time basis, they received a big bonus, they sold a rental property, and especially if they expect to be in a lower tax bracket in retirement, generally RSPs make sense when you can put money in at a higher tax bracket than you're pulling money out. And, you can certainly tap your TFSA to take advantage and use the tax refund to pump that back into your TFSA. So it's a win-win.
Mhm.
Mhm.
And Hannah, on your side, have you ever run into any situations with clients, some mistakes that you see some people do that you think the listeners could learn from?
I think we've covered them already, but I'll just reiterate them. So
Sure.
using two or more TFSAs, it's just really risky to over contribute. People do it all the time. It's so easy to happen. So just make your life easier. Consolidate them. Just use one. Just, are they using risky investments in their TFSA? And then also are they underutilizing their TFSA? Like Jason said.
Yeah.
So
Mhm.
yeah,
The
those
only
are
the
the
only one that
strategies.
I'll add is I don't see this a lot. I don't know about you, Hannah, but if somebody is day trading in their TFSA,
Oh yeah, of
there's been a
course.
few court cases where, and day trading, you can get in trouble day trading your TFSA because if you're doing very frequent trading, it can be considered business income. And if
Hmm.
you
Oh,
are
okay.
considered to be operating a business in your TFSA, I know it sounds weird, right? You're just sitting there like buying stocks at home. You're not operating a business, but TRA can take a different position and say, no, that's fully taxable business income as opposed to tax-free TFSA profits. And there's no real line in the sand to say this is what constitutes day trading.
Hmm.
Most people that are day trading know they're day trading. They're moving in and out of stocks frequently. And again, like what's frequently, I don't know. Again, there's been some CRA cases where you can see there's been X number of transactions per month or per year, and that's led to a day trading position by CRA.
From your experience, do you find just working with different clients over the years, have you found that people also tend to forget to reinvest their dividends? So they just end up, like you mentioned, someone sitting on too much cash in their TFSA. Maybe there wasn't cash there initially, but then they just forgot to reinvest, and now there's like thousands in there that's accumulated that is just sitting there pretty much idle. Does that something that happens, or do you think people are pretty good with that?
I've definitely seen it in all account types, I guess.
Mhm.
People forget that there's that job that needs to be done. But typically people who are DIYing are pretty on top of it.
Mm.
Great.
Yeah. If they're diligent enough to learn how to be good DIYers, they probably
Yeah.
have that. Yeah.
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 They'll see a big cash line there and say, what is that?
Yeah. Yeah.
Probably don't want that.
They probably look forward to and enjoy it when they get that notification. I know I do.
Mhm.
It's like, because it feels like free money,
Clearly
right? Or
invest
just like,
that.
oh, I didn't have to do an hourly job for this. This is great. It's like it feels like a bonus every quarter you get.
I did have a client case recently where a client who tends to chase sort of introductory rates for savings accounts and GICs and stuff like that, quote unquote, found a relatively large account. It was a TFSA account in this case that they had forgotten about for a few years. It's nice to find money. I don't find money. Like I find bills. I find like repairs and kids' expenses. I don't find money, unfortunately, but some people are lucky enough to find it. So you got to be careful about, opening multiple accounts in multiple places, especially extremes like that.
For sure. That makes sense. All right, awesome. Let's change gears a bit and talk about RSPs next. Are there any changes to RSPs that we should be aware of for 2024? And for anybody new to all of this, can you give us a refresher on how RSPs work for us Canadians when it comes to minimizing our taxes?
For sure. Okay, so the new RSP limit this year is $31,560, or 18% of last year's earned income, whichever is lower. Plus, we also keep any unused contribution room from the previous year. And it's also really important to remember this year that the deadline is February 29th, not March 1st, like it commonly is. Yeah.
Oh, okay.
Yeah. So RSPs are tax-deferred accounts. So that means you're not charged income tax when you put money into the account up to your contribution limit. When you report the RSP contribution on your tax return, your net income line is reduced by that you put in. And many people are employed and have already had tax withheld by their employer on their paychecks, and that's why they'll often receive a big tax refund for making an RSP contribution. Other thing to remember is that tax in an RSP is just deferred to a later date, ideally when we're retired. So the benefit with an RSP and the key to it, which is what Jason had mentioned earlier, is recognizing that the purpose is to reduce our tax rate over our life and not remove it. So because of our progressive tax system, we're basically trying to reduce our taxable income today to a lower marginal rate and do the same thing in retirement and overall reduce our lifetime overall tax rate.
Mm-hmm. And in case someone's hearing about the RSP deadline for the first time, is a good way to summarize it to just say that basically in those 2 months, you guys to basically choose whether you want that to apply to your previous tax year or the current one?
Exactly. Yes.
Okay.
And that's why you have until February 29th to make that RSP contribution. You need time to analyze your 2023 income to make a decision about whether you should contribute or not and how much. So the deadline lines up quite tidily with when you're due to get your T4. The deadline is February 29th. So that most people look at their T4 and then make a decision. Alternatively, business owners and those with rentals might need time to go through all their expenses, add it all up, and then make a decision from there.
Interesting. So is that why the government did it that way? So that you have time to kind of absorb and think and say, okay, do I want to apply to this?
Yeah. But now that you're asking, I'm like, hey, I actually don't know. That's what I always thought. But
because it complicates things, right? For like the average Canadian, it's like, oh, wait, it's a new calendar year, but it's still applying to it. Like it adds confusion, but I wonder if that's why.
But yeah, you're so right, Cornell. I actually don't know if that's the reason. I just assumed. And now as soon as you were like, is that it? I'm like, wait, pump the brakes.
I should not have asked you that question. It's like, can you please tell me exactly what the government's intent was, even though you don't work for them directly?
No, yes, but that's what I always assumed to be the case. And
it makes sense though.
Yeah.
Because it gives you time to digest a bit and then decide how you want to play things
business
strategically.
Owners, they have to take a long time to do their books,
For sure.
to get it all in order. So
I think the one place where people get confused sometimes on that extra 60 days too is the odd time, we'll see somebody who will send in an RSP contribution receipt for, January 2023, let's say, with their 2023 taxes. And technically that January 2023 contribution should have been claimed on their 2022 tax return. Likewise, with a contribution made in the first 60 days of 2024, it should be claimed on your 2023 tax return. And claimed is a really important word to sort of elaborate on, because you report the contributions that you make in the first 60 days on your tax return for the previous year. You actually don't need to deduct them. You don't have to deduct your RSP contributions in the year that they're made. You can carry them forward indefinitely to use in the future. But normally people don't carry forward RSP contributions for very long because they mean tax refunds, and people prefer to get tax refunds in their hand. So just a little nuance to be aware of. And maybe one other one is if somebody's in a fortunate position that they've already maxed out their RSP for 2023, and they've got a bunch of money they want to invest for 2024, you could estimate your RSP room. So you don't get your RSP room technically, I guess, until you file your tax return and CRA calculate that based on 18% of your income for the previous year. But if you know you had a relatively high income, or say you had $100,000 income, and you know you're going to have 18% or $18,000 of new RSP room, your RSP room becomes available retroactive to January 1st of the year. So somebody could front and load their RSP contribution. Just be careful you don't misestimate and, over contribute, because there's penalties there too.
And I guess we should mention too that when we talk about the RRSP deadline, we're not saying that you should definitely wait until until the new year to start putting money in your RRSP. This is more so, I think, and correct me if I'm wrong, like from your experience, this is more like of a call to action for people that have sort of been not, I guess, investing throughout the year, perhaps. And then now it's like, hey, this is sort of your last chance to have it apply to your previous year if you want it. So if you're going to take action, kind of now is the time, because the deadline's coming and then you won't be able to apply it to the previous year anymore. Is that a fair statement to say? Would you agree with that?
I think so. I feel like it's more like bank marketing. It's RSP season, get in, give us your money. I always found it sort of like that. Like there's no reason that you should have to panic in February and make an RSP contribution, right? But ideally, people are proactive and making their RSP contributions over the year rather than scrambling at the last minute, unless there's something extraordinary that happened. Again, a really high income year or some sort of windfall. But it's RSP season in February, so it's coming.
Yeah, because when I see this marketing around that time of year, it definitely seems like it's more targeted to people that have not been, let's say, investing a portion of every paycheck. Instead, it's like, oh, shoot, I forgot I should probably be saving for my retirement. And then my advisor just told me that I should be, putting that there's this deadline, so I should probably go and do it now. It seems like it's more geared towards that. Whereas really the best practice I would argue is you're saving a portion of every paycheck and investing that, not waiting for some, this deadline because you forgot, because you've been procrastinating on it for this entire, not to say everyone procrastinates, but just, I guess don't want it to sound like, oh, it's normal to wait until the end of February. It's like that shouldn't be where your head's at. It should be, no, I'm investing a portion of every paycheck. Would you agree with that, or do you have a different opinion on it?
That's totally fine. I just want to mention one alternative strategy is sometimes people save and invest all year long and then wait to get their pay stub or business books done, figure out what an appropriate amount of a contribution is, and transfer their investments in kind to their RSP. Because some people have really variable income, like really variable, and have trouble tracking it. Like if you're a young family who's super busy, and you are paid on commission and your income is wildly variable, maybe it's just simpler for you to strategize on that in February. And sometimes I'll do that with people, again, who are just starting out. I might say, why don't you save to your TFSA now? And we'll figure out what an optimal contribution is at RSP time and move the amounts in kind. And that would be, of course, somebody who's not maxing, right? It's not close to doing that, but something to think about.
I think the other thing is there's, a lot of people who are working in the business world who get bonuses in the new year. And we see a lot of executives in particular who receive their annual bonus in February. Canadian companies tend to tie it to sort of the RSP deadline, and people have a lump sum of money to invest then when they're not or not.
Gotcha. That makes sense. No, thanks for that. I never thought of it from that angle. That sounds good. Can you guys speak to the RRSP loan strategy? This is something that we often hear mentioned in different blogs and books on finance for Canadians, but do they still make sense in this higher interest rate environment that we're now in?
I think if you're having that situation Jason mentions where you're having a high income year, like it's a one-off, maybe it can make sense to do that. Or maybe if you've got some one-off thing, if you're in the highest marginal tax bracket, you'd get half of the money back quite soon. So you might only have to repay half the loan. But the problem is when people rely on this strategy, is that you struggle to pay it down in general. Even when interest rates are lower, people are taking out a loan and repaying it for an entire year. And then you're just like on a hamster wheel here. Like you're never getting ahead on your RSP contributions. And now it's expensive. It's really expensive. So a TD RSP loan, I've checked it out, and they're doing prime plus 0, so 7.2%. So, some people might be familiar with the concept of evaluating whether you should borrow to invest by comparing the rate of return on what you could potentially get for an investment to the interest rate on the loan. So some people might say, oh, you need 7.2%, which is hard enough to get a guaranteed 7.2%, but RSP loan interest isn't tax deductible. So you need to factor in your marginal tax rate for a fair comparison. So if your marginal tax rate is 30%, you could argue that you need to earn over 10% a year guaranteed to come out ahead, which is very difficult. So yeah, like I would want to say impossible, but I won't for the guaranteed part. But so if you can pay it off quickly because you've got an upcoming windfall or something, or it's a one-time income event, it could still be a good fit, but you're still behind and starting the year out in debt. And those are all factors that should be considered rather than just the math.